Hi, this is Stuart Cooper, and today's date, July 8th, 2022, and today we're going to go over the current interest rate environment and why rates are going up. And why was there a big increase today? And it's based on here. So if we look at the economic calendar and we go down here, and let me go to today, non-farm payrolls for June. It was anticipated to be at 268,000. That was the forecast, and it was 372,000. Well, that sounds great. You know, more jobs created. It's having a negative reaction on the bond market, and this is the reason why. Is because the Fed is raising interest rates to slow things down. And with this new high job numbers coming out, it shows that the effect wasn't as effective as the Fed had hoped. And now there's more fear that the Fed's going to even increase interest rates even further. And this pretty much is telling the Fed that they got to continue doing what they're doing, if not more so. So that's why we're seeing the raise in interest rates today. And if we look at my little indicator on where the markets are moving, you can see this has gradually moved over to the darker red over the last couple of days, which means, you know, definitely further increases in interest rates coming. And that's exactly what that indicator is. So let's do this real quick. Let's take a look at the last 6 months. And I wanted to point something out to you. So over the last 6 months, what I was concerned with, and if you saw the previous videos, I talked about the last few days. I talked about we were most likely going to bounce off this level right here and jump up, and that's exactly what we did. So you can see right here about 2.715 around here, 2.748. This is the resistance level that we bounced off a few times over the last few months. You see this right here, this line, this is the resistance. So what happened is we had the last 3 weeks, we had improved pricing, and we got pretty good pricing, pretty good improvements in interest rates. And now we're bouncing off it and we're starting to tick back up. And I believe we're going to definitely keep ticking back up here somewhere. We'll probably end up here somewhere in the next week or so. So rates are going to further deteriorate most likely based on the graph that I'm looking at and the information that I am reading. I just wanted to share this graph with you because I wanted to put this in the context. So what we're looking at is we're looking at what interest rates have done since like 1975, I believe. Yeah, 1975. And you can kind of see, yeah, rates have gone up quite a bit in the last 6 months, but that's because we were at historic lows. So if we just look at this graph right here, you can see like in 2008, we were around 6%. 2000 almost 8%. So you can see over time rates have historically been higher than where we're currently at. So you really need to put this into perspective. So I just thought I'd bring this to your attention. And I also want to share with you that I'm going to be coming out with a video in the next couple of days that's going to be comparing different loan options as far as like fixed rates versus adjustable rates in true market conditions to see what the difference is really in savings. Does it make sense to switch over and get an adjustable rate and take that risk versus going with a fixed rate? So I'm gonna spell that out to you, and we're gonna break down the numbers. So definitely stay tuned. You know, the only way you can get access to that and be notified of these videos is if you go ahead and like my channel and subscribe. So anyway, have a great weekend, guys. Take care.